Hi, I'm John Persinos, Editorial Director of Investing Daily. Be sure to visit our website at investingdaily.com. Also, visit the website of our subsidiary, streetauthority.com. My number one goal is to help you make money. So let's get right to it. In this video presentation, I'll recap the major events of the past week in the financial markets, analyze their impact, and take a closer look at what investors can expect in the week ahead. Investors must be prepared for heightened volatility this week. In these treacherous times, diversification and adaptability are especially important for investors. Until we get through this autumnal rough patch, stay patient and keep your emotions in check. At least 15% of your portfolio's allocations should be in cash so you can pounce on buying opportunities as they arise. Last week marked the beginning of the third quarter earnings season, with major companies reporting their quarterly results. Early reports showed positive results. JP Morgan Chase, Wells Fargo, Citigroup, and PNC Financial Services all reported earnings that beat expectations. More about earnings season in a minute. Geopolitical risk has come to the fore with a vengeance as the Israel-Hamas war plunges the Middle East in its worst violence in 50 years. However, history tells us that the shock to investor confidence of military conflict tends to be short-lived. Stocks always revert to the more sustainable, fundamental and technical drivers of returns. Back here at home, political dysfunction in the leaderless U.S. House of Representatives is making investors leery and voters angry. It's anybody's guess as to when the clown show to find a new speaker finally ends. The specter of inflation continues to haunt investors. The Consumer Price Index, CPI, and Producer Price Index, PPI, reports for September, released last week, indicated a higher than expected increase in prices, sending anxiety through the market. Inflation has been moderating over the long haul, but remains persistently elevated. The Fed doesn't have sufficient cause to claim victory over inflation just yet. Amid this mixed inflation data, investors nervously await the next Federal Open Market Committee FOMC monetary policy meeting, October 31 through November 1. Wall Street is betting that the Fed will hit the pause button on rate tightening, but the central bank could deliver an unpleasant surprise and decide to hike instead. Last week's volatility is likely to carry into the coming week. The CBOE Volatility Index, the VIX, has surged past 19 to knock on the door of the pivotal threshold of 20. A reading of the VIX above 20 indicates that the markets during the next 30 days will undergo sharper volatility. The good news is that the S&P 500 notched its second consecutive week of gains last week. For the week, the Dow Jones Industrial Average rose 0.8%, the S&P 500 rose 0.4%, and the tech-heavy Nasdaq fell 0.2%. The benchmark 10-year Treasury notes settled at 4.62%. Oil prices surged 5.9%. In a bullish technical sign, the S&P 500 currently hovers above its 200-day moving average, and it's getting closer to its 50-day moving average, denoting upward momentum. Discussions surrounding increased regulation of the technology sector gained momentum last week. Antitrust concerns and data privacy issues are pushing governments to consider stricter regulations on tech giants, which could hurt their profitability and market dominance. Regardless, Microsoft last week finally cleared regulatory hurdles and closed its $69 billion acquisition of gaming giant Activision Blizzard, a reflection of the limits of government power over big tech. Now let's take a look at the week ahead. Earnings reports will continue to play a pivotal role in shaping market dynamics in the coming week. For Q3 2023, with 6% of S&P 500 companies reporting actual results, 84% of S&P 500 companies have reported a positive earnings surprise, and 66% of S&P 500 companies have reported a positive revenue surprise, according to research firm FactSet. In aggregate, actual earnings reported by these companies have exceeded estimated earnings by 10.1%. Therefore, although it's still early in the season, both the number of companies reporting positive earnings surprises and the magnitude of these surprises are trending above the 5-year averages. For Q3 2023, the blended year-over-year earnings growth rate for the S&P 500 is 0.4%. If 0.4% turns out to be the actual growth rate for the quarter, it will mark the first quarter of year-over-year earnings growth for the index since Q3 2022. The following economic reports are on the docket in the coming days. Retail sales and home builder confidence index, Tuesday. Housing starts, building permits, Fed Beige Book, Wednesday. Initial jobless claims, existing home sales, and U.S. leading economic indicators, Thursday. Throughout the week, various Fed officials are scheduled to speak. Watch out for clues as to the Fed's intentions. Amid this frustrating investment climate, are you looking for market-thumping gains? Consider the advice of my colleague Jim Pierce, Chief Investment Strategist of Personal Finance. Case in point, if you had taken the initial recommendation of Personal Finance to buy Chevron and held on, you'd be sitting on a whopping return of nearly 3,200%. And no, that's not a typo. Want to get aboard the next Chevron? Click the URL at the bottom of the article that accompanies this video on the Investing Daily website. Well, that's it for now. If you have any questions or comments, drop me a line at mailbag@investingdaily.com. Thanks so much for watching.